Since February, the bond market experienced a sea change. Rising energy prices from the Iran conflict have shifted expectations. Central banks are now expected to raise rates, not cutting anymore. Bond yields are at multi-decade high across developed economies. Some are at their pre-global financial crisis level. But here's what matters. Higher government bond yield means long-term investors can earn higher income with minimum default risk. Let's put this in perspective. First, investors have already priced in substantial rate hikes and inflation expectations. The surprise factor is largely gone. This suggests shorter maturity bonds, especially those under 5 years, has the potential to beat cash return over the next 12 months. Second, AI-related investment. They're driving upbeat economy activities and optimism about future growth. This is resulting in savers demanding for higher compensation. We too are expecting bond yield to remain elevated, but we caution that there may not be enough skepticism embedded in growth expectations. A third point, which is higher government bond yield, reflects investors seeking higher risk compensation for rising fiscal spending and debt loads. We believe the steep yield curve in the very long maturity segment largely compensates investors for this risk. The fourth and the final point, if the Iran conflict reaches resolution soon, long maturity bonds return could significantly exceed cash returns. Wrapping it all up, our strategic views are we prefer short maturity bonds, especially the investment-grade corporate bonds. The economic backdrops allow investors to earn extra income from these securities. Regionally, Japan offers the highest yield globally after hedging away the currency risk, and it is loaded with the most bond risk premium. In Canada, we anticipate Bank of Canada will raise rate by 50 basis points over the next 12 months, pushing the 10-year bond yield to 3.75%. The bottom line, government bonds are becoming attractive. You have higher income and you get global bond market dislocation, present meaningful opportunities for investors willing to look beyond the headlines.